Hello and welcome to AFM 451. In this video, we focus on how auditors evaluate material misstatements at year end and translate individual findings into an overall conclusion on financial statement integrity. As testing progresses, misstatements inevitably emerge. The first step is categorization. Auditors distinguish between known, projected, and judgmental misstatements. Known misstatements arise from direct testing. An invoice was recorded twice. A shipment was recorded in the wrong period. An expense was incorrectly capitalized. These are factual differences between what is recorded and what should have been recorded. Projected misstatements extend from sample findings to the broader population. If errors are identified within a selected sample of transactions, we estimate the likely impact on the full account balance. This requires disciplined sampling methodology and careful projection logic. A small error rate in large population may translate into a significant projected adjustment. Projection ensures that we do not understate the potential magnitude of misstatement simply because we tested only a subset of transactions. Judgmental misstatements are different. They arise from differences in professional judgments rather than clear factual error. Management may estimate an allowance for doubtful accounts at one level, while auditors' independent range suggests something else. Inventory obsolescence assumptions, fair value measurements, or warranty provisions often fall into this category. These differences require careful evaluation of assumptions, methodologies, and biases rather than simple recalculation. Materiality frames the entire analysis. It's not purely quantitative. While numeric thresholds provide discipline, qualitative factors also matter. A misstatement that affects compliance with debt covenants alters a key performance metric, or masks a trend may be material even if numerically small. Intentional misstatements carry different implications than unintentional errors. Materiality therefore incorporates both magnitude as well as the proper or appropriate context. Aggregation becomes critical at year end. Individual misstatements that appear immaterial in isolation may, when aggregated, exceed the tolerable thresholds. We compile all identified differences, including known, projected, and judgmental amounts. We assess the cumulative impact on earnings, assets, liabilities, and disclosures. Patterns matter. Repeated overstatements of revenues or consistent under-accrual of expenses may indicate directional bias, even if each item alone seems small. At this stage, communication with management is essential. Proposed adjustments are presented. Management may agree and correct the financial statements. If management declines to adjust, uncorrected misstatements remain part of the overall or aggregate evaluation. The auditor must then determine whether the remaining differences, individually or collectively, result in a material misstatement. The ultimate objective is to safeguard the integrity of financial statements. Evaluating misstatements is not about perfection. It's about determining whether the financial statements are presented fairly in all aspects, in accordance with the applicable financial reporting framework. That determination rests on disciplined aggregation, sound judgment, and most importantly, an awareness of both quantitative thresholds and qualitative implications. Let's consider an example to run this home. Consider a manufacturing company with a pre-tax income of $10 million and an overall materiality set at $500,000. During testing, the auditor identifies a known misstatement of $120,000 related to, let's say, duplicate revenue entries, and projects an additional $180,000 of overstatement based on sampling error in sales cutoff testing. In inventory, management's obsolescence provision appears understated by another $220,000 relative to the auditor's independently developed range, resulting in a judgmental difference. Individually, none of these three items, as seen here, exceed materiality. However, when aggregated, the total potential overstatement of income approaches $520,000, slightly exceeding the materiality threshold. Beyond the numbers, the pattern reveals consistent upward bias in earnings. Revenues overstated, expenses understated. The revenue error also affects a debt covenant tied to EBITDA, introducing qualitative significance. Now, let's say management agrees to correct the duplicate revenue but declines to adjust the full inventory provision, arguing that future demand may recover. The auditor reassesses both quantitative impact and qualitative context and concludes that the remaining uncorrected difference, while close to materiality, may not render the statements materially misstated when considered in the context of financial statements as a whole. This final evaluation integrates known, projected, and judgmental misstatement, applies both quantitative and qualitative materiality, and ultimately supports a defensible audit opinion. which is grounded in disciplined judgment. When this evaluation of this sort is performed rigorously, consistently, the resulting opinion reflects more than just arithmetic accuracy. It reflects an integrated assessment of magnitude, pattern, context, and credibility. That comprehensive perspective is central to an effective audit quality. Thanks for following along. Take care, stay safe, and bye for now.